All right. How's everybody doing this evening? Hope everybody's having a great week so far. Welcome to the cast this week. Tonight, we're going to go over types of investment vehicles, talk a little bit about that, continuing to lay the foundation for, our financial planning, our retirement planning. This will give you some base information as we go deeper in coming weeks as far as how to utilize these different things and how it factors into different plans. If you didn't check out last week, we talked about pre-retirement checklist and retirement blunders. Those are out there. That's out there posted on the Facebook group. It's also on the YouTube page. There's some guides documented out in the guide section. So check that out if you haven't already. If you have any questions, just hit me up. Either send me a Facebook direct message, make a comment on the post, whatever it may be, and I'll be happy to answer any questions and get back to you. So let's dive in tonight. So let me share my screen here. We'll go through some of this. Share screen. All right. Here we go. So as we're talking about different investment types, there's a lot out there, and there's more than just what we're going to cover tonight, but these are the most common. And we're going to cover most of the ones that are more, let's just say, common and basic to most investors that you would utilize in a plan. Some of them kind of toward the tail end are a little more, let's just say, professional and firmish, if you will, for investment firms. But it's good to know about them, because if you're not doing it yourself and someone else is, you need to be educated on what that person's doing for you. All right. So let's dive in. So different investment vehicles. So we're going to go over 10 or 11 here tonight. And again, this guide will be posted in the group section, in the Facebook group, rather, in the guide section. So we're going to go through all these stocks, bonds, CDs, mutual funds, ETFs, options, annuities, commodities, retirement plans, precious metal. We're going to talk a little bit about crypto as well. These are the most common, and these are what you would most likely run into either doing it yourself and or working with an advisor. So, there's a lot out there, and it can be very, very intimidating. So education is key into knowing what these are before you just dive in. Obviously, I'm here to help if you have any questions. But let's dive into the main top 10, if you will. So stocks, probably most people know what stocks are. They're also known as equities. If you've never heard of that term, equities, that is stocks, right? You can have U.S. stocks, or U.S. equities, or you can have international stocks and equities as well. And if you're doing a stock portfolio, you're generally going to have a pretty good mix. And it's depending upon where you're at in your journey, as far as how far off in retirement you are, how aggressive you're going to be, will be determine the type of stocks that you get into, and also your allocation between U.S. Or domestic, you might hear referred to as that, and international. They both markets act a little bit different. When I say markets, I'm just talking U.S. and international. Now, when you dive off into those different markets, so if you look at the U.S. alone, there's more than just one way to buy stocks. The two main ways are the New York Stock Exchange, and then there's NASDAQ, which is also referred to as over the counter. Those house the majority of the stocks in the United States. There's also some other things where they're, penny stocks and pinks, those kind of things. Those are a lot more risky. So typically we're going to stay away from those. But diversification is key in everything that we talk about with investments. Diversification across these different investment types. But if you're doing a stock portfolio, diversification in a stock portfolio is key, because you don't want all your eggs in one basket, because if that one company or that one sector goes down, then you don't have anything to help carry you along. What I mean by sector is, if you're investing heavily in tech stocks, or in biotechnologies, or commodities, or retail, whatever it may be, you want to be diversified. And it takes some investigation and some education to go out there and analysis to figure out where you need to be. One thing I always want to warn people against with the stocks is don't try to time the market. Yeah, you can get lucky sometimes, but you can get really burned as well. There's no true hard way to predict the market. Go off of core fundamentals of those companies. Right now, there's different techniques in how to get into stocks. There's some companies some people, investors and lenders and stockbrokers will do it based off of pure value and foundationals of the company. Is it a good company? Is it good products? Do they have good strategy, good leadership? There's technical analysis where you get into charting stocks. That gets into a little bit of predictive analysis, but there's still no true way to predict, right? Even the things of the past don't necessarily predict the future when it comes to stocks. And while you may see some patterns, you got to know when to get in and out. So timing can be very difficult unless you're a very, very seasoned investor, and even then you can get burned. So obviously you make money in the stock market by, buying low, selling high. Buy the stock low, sell it high, make the difference in the middle. Now, one thing I want to say out of the gates with all investments is you got to be wary of capital gains, right? Capital gains tax means that the money that you make on that investment. So if you buy a stock for $100 and you sell it for 150, you got to pay tax on that $50. And the capital gains tax typically is a little higher than your income tax. Now, your capital gains tax percentage can vary depending on what tax bracket you're in, and how much of investments you're doing. There's also short-term capital gains and long-term capital gains. Short-term capital gains is stock or investments held under a year. That capital gains tax is higher. If you hold on to a stock longer than a year, then it's long-term capital gains, and they don't charge you quite as much. They're trying to, or don't tax you quite as much, trying to encourage investment in the market, right? So a lot of things hedge around stocks. Obviously you hear that in the market a lot. So I'm going to move on, but we could talk about stocks for days. We can get deeper into this in further sessions, and/or hit me up, and I'm more than happy to talk through it. So the next thing on here is bonds. Basically, you're lending money either to a government segment or to a company. You're giving them a loan, and they're guaranteeing you a rate in return. Not guaranteeing, they're giving you a rate in return. The only ones that are close to guarantees are like municipalities, those kind of bonds. Bonds are not as risky. Municipal bonds and government bonds, but there are different types of bonds. There's high yield bonds, meaning they pay out a higher yield, a higher percentage, but they're also more risky. So you have these corporate bonds. So corporate bonds, same kind of thing. You're basically lending that company money, and in return, they're going to pay you back out to buy that bond back. And usually they have a time frame put on it, but your risk there, and they have a rate of return on it. But your risk there is if the company goes under, or they default, or they go bankrupt, there's a little bit of risk there in regards to bonds. So again, the risk is a little bit lower, but they also don't make as much money. It's basically a lending vehicle. So the companies out there can issue stocks, or they can issue bonds to raise money, right? Next one down is mutual funds. A lot of people are probably familiar with mutual funds. If you have a 401k or 401(b), or different employer retirement accounts, most of the time that's about all you can invest in is mutual funds. And basically what mutual funds are is a collection of different stocks in one fund. So one mutual fund may buy stocks from 5 to 100 different companies, and a lot of times those mutual funds are segmented into areas of the markets. They can be either, like I said earlier, technology or retail or real estate. There's also mutual funds that are tied to different types of stocks, right? There's things called large cap stocks, mid cap stocks. There's, I could go on for a while and list out all the different type of stocks, but those mutual funds can invest in those different areas. So what it does is it pulls a group of people's money together to buy these mutual funds. Now, mutual funds are loaded with fees, and they're great for 401ks and those kind of things. And you may have seen one of my posts earlier on YouTube. What I recommend for the 401ks is invest up to your employer match, what they match dollar for dollar, but don't put any more into that. We can make your money work for you a lot better in other areas. And the reason being is on a 401k or 401(b), you're only able to invest in mutual funds for the most part. Some that are allowing annuities and a few other things, and some will actually offer a Roth option. But one, you're paying administration fees for the person running the 401k. Two, there's fees in the mutual funds, and a lot of them are hidden, so they're hard to see. And they don't get that great of returns in all reality. You don't have as much flexibility because they limit you to a very narrow box of funds that you can get into. Again, take advantage of the employer match. If they're matching 3, 5, 6%, take advantage of that. but anything above that, you want to put in somewhere else, right? And don't ever leave your 401k money in an old employer. You want to roll it into a better vehicle because they get loaded with even more fees on top of that. And the thing there is, like, I'm not saying mutual funds are bad, because you can definitely save and make money, but I would only really utilize them. My recommendation is only utilize them in a 401k. Little history there is, and actually the way the 401ks came about, mutual fund companies are the ones that started those, and now they're, with mutual funds is or 401ks is basically all you can get into is the mutual funds. Hopefully someday they'll open it up to more investment vehicles. But same kind of thing. You're selling your way you make money on here is you're hoping that those funds and the stocks that are underlying in those mutual funds grow in value, their price goes up, and then hence your return on them goes up. Now, exchange traded funds are a little bit newer into the arena. I say newer; they've been around for a while, but basically they work. They're called exchange traded funds, ETFs. They basically work in essence like a hybrid between mutual funds and stocks. The great thing about exchange traded funds is that you can buy and trade them like a stock. So on a daily basis, you can go in and out and sell them like a stock, so they're faster. Whereas the mutual funds, you have to go through a settlement. Well, they all have to go through a settlement process, but it takes a day to go through, right? And they settle out on the mutual fund at the end of the day of that price. Well, an ETF, you trade it just like a stock on the stock exchange. The beauty about this is on ETFs, there is no fees tied to ETFs, unless you're paying a commission on a brokerage. But most of your brokerage houses now, you can go trade for free up to X amount of trades per month. And the ETFs are really good for beginners and intermediate investors, because ETFs also gather stocks together into segments. So you could invest in a section of the market. If I think, real estate's really hot, then I can do a real estate ETF. I think precious metals is doing great, I can do a precious metals ETF, or whatever. There's ETFs for all kind of different segments of the market, and broken into different areas of the market. There's also index ETFs that follow like the S&P 500, which are basically the 500 stocks that make up the S&P. It mimics that, and it helps auto diversify your portfolio. I love ETFs because they're a little bit easier. You don't have to do quite as much investigation and analysis as buying an individual stock, but at the same time, they help you diversify. They're easy to trade, and there's no fees. So great vehicle. You make money the same way on those as you do a stock. Buy low, sell high, right? Certificate deposits, most people probably have heard of these. You go to the bank and you're giving them an X amount of money for X period of time, right? So you go in and you buy a 5-year CD, whatever increment, 1,000, 5,000, whatever it may be, and they give you a guaranteed rate of return or interest rate that's usually higher than a savings account, but not much. CDs are obviously very low risk because they have a guaranteed rate of return, but the returns are very, very, very low. You're not going to get rich off of CDs. You're not going to grow your portfolio drastically in CDs, and there will be a penalty if you withdraw them early. So they're safe, very low rate of return. Now, retirement plans are not necessarily an investment vehicle per se, but they're worth calling out. We already talked a little bit earlier about 401ks, 403bs, the employer-sponsored retirement accounts. And so with those, they're great in the sense that they're tax deferred. So money is being put into those, money's taken out of your paychecks, putting into those before taxes are taken out, right? So your money is growing tax deferred until you withdraw that money in retirement. Some companies now are offering a Roth IRA inside of a 401, which means you're pretty much paying that post-tax, but you withdraw the money out tax-free. One thing to be thinking about if you do, and you can probably do both. A lot of companies that offer it, you put part in a traditional and part in a Roth. But with the Roth portions of that, only your contributions can go into the Roth portion of the 401k. The employer match cannot. It has to go into the traditional side. That's just IRS regulations and rules. We'll touch a little bit deeper into different types of IRAs a little bit later in another session, because there's traditional and the Roth, and I'll explain the difference between the two. But 401ks, like I said, if your employer offers one and you have a match, definitely take advantage of it. If you don't have an employer-sponsored plan, or your employer doesn't offer one, you're self-employed, there is other ways to do tax-deferred investments, right? There's definitely ways to do that. Options is a little bit more advanced and a little more complex. I do not recommend these for individuals that are just getting started in stock trading or investing or even intermediate. They're a little more complex. Basically, options gives you buy an option that gives you the ability to buy or sell a stock at a set price within a certain period of time. So you're hedging and betting that a stock's either going to go up or down based on the type of option that you buy, whether it's a put or a call. So a little bit of a gamble. So you buy this option. So basically what that does is you have to purchase the option, right? And that costs you a little bit of money. And then that option is good for a period of time, and it gives you the right to buy a stock at a given price or to sell a stock at a given price. So if you've done your research, you can hedge it a little bit, and if you hit it right, then you can make some money. That is one way you can make money in a down market or stocks going down. You can short the stock and you can make money on the downward trends. Again, a lot more advanced. You really got to know what you're doing dealing with options. And then in annuities, a lot of you probably heard of annuities, maybe some of you haven't. But basically, you put in a lump sum of money, or you can make payments into it for guaranteed income down the road, right? So you get a guaranteed paycheck or withdrawal out of that fund later on. It's a cornerstone of retirement planning. It's a cornerstone to cover those core expenses in retirement. So remember back in one of our earlier sessions, we talked about the different buckets and the different levels. You have to cover your core expenses, the needs. I mean, that's your core. The best way to do that is cover it with guaranteed income. Annuities is one way to do that. Now, annuities have a lot of different types, right? I typically stay away from variable annuities because they're tied to the stock market. They fluctuate more. They don't have the guarantees, and there's a little bit of fees in there. But there's fixed and fixed index annuities that have built-in guarantees, meaning you cannot lose money. You have the upside, but they have guarantees. So if the market goes down, like this but the downturn that we've had the last year or so, your investments will not lose a dime, right? So that's great. Now there's a cost to that. So the upside, you still get the upside, but there's usually some caps there. But it's a cornerstone. That and a couple other forms of guaranteed income are cornerstones in retirement planning to cover that base needs. Now, when you get into the wants and the nice to haves, no, we're going to fund that with other things, and not necessarily all your needs would be covered in annuities. Again, you want to be diversified. You don't want all your money in annuity, but you want a chunk of it to cover the needs, right? Now, the way they're designed today is, like I said, there's no fees to them. They have guarantees, and it gives you a peace of mind that your core expenses are going to be covered in retirement. And the good thing about those as well, even if your money runs out, you start taking payments and your money runs out, they're guaranteed to pay you for a lifetime. So even if your bucket goes to zero in that fund, they're still paying you. Which is quite attractive in these days, especially with the average age of someone living. The lifespan is a lot higher than it used to be, right? A lot of people say, well, I'm not really sure about annuities. Well, guess what actually is an annuity? Social Security is an annuity, right? You've been paying into it, for a number of years, and they're going to give you a guaranteed payout for the rest of your life. Social Security is an annuity. But you got to do them right. You got to get educated about them. You got to choose the right ones. Choose the ones that don't have the fees. There's definitely some great products out there that have the guarantees and riders, and it makes things a lot highly flexible for you. Great product to cover those core needs. We'll talk more about that later. Derivatives, again, another higher end option. It's an instrument that basically drives value from another asset. So kind of like what an option, in fact, I'm going to go down here. Options that we just talked about earlier is a derivative. You buy something that's tied to the value of something else, right? So options, futures, and swaps are the main types of derivatives. I only mention these because not most investors that are doing things on their own, if you're doing investments on your own, you're probably not getting into derivatives. But if you're working with someone that does, you really got to make sure they know what they're doing. And this is really more can be higher risk, and that really only play a certain role in a portfolio. It shouldn't be a mainstay in your portfolio unless you already got everything covered, and now you're on to the nice to haves and being a little more risky. Like I said, you really got to know what you're doing with derivatives. All right. So, and then commodities, you may have heard of commodities. Basically with commodities, they're hardcore things. So metals, agriculture, livestock, energy. So what are you going to say? You're not going to go out and necessarily buy metal or buy a cow, but you can buy stocks that are even more advantageous, easy to do, is buy ETFs that go into commodities. A lot of people will get into ETFs and commodities to help hedge inflation. That is one inflation hedge. but it's not the only inflation hedge. Actually, stocks are a great inflation hedge as well if you get into the right ones. I posted a thing out there earlier about inflation hedges. And what some of the best vehicles are for that, and then the studies of them. It was kind of surprising what some of the best inflation hedges were for and stocks and equities being one of the main ones. Commodities and real estate were up there, but usually fairly safe. An easy way to get into it is in ETFs. So now we're talking about all this. Well, how do you buy these different investments? So you have to have an online a brokerage account. And nowadays you can get a free brokerage account and they don't charge you for trading. Or if you're working with advisors, sometimes they can help you get that set up. But you can get your own online brokerage account, and you can manage your own investments, or your financial advisor can work with you and manage those investments. That's you got to have a brokerage account to do those things. The other side of it is have the financial advisor just do that all for you. They're going to sit down and take a look at your what your strategy should be, your risk tolerances, what your goals are, come up with a plan, and manage that for you. So there's just a ton of different ways to invest. There's different vehicles, and there's a lot more than here. Like there's pure real estate, buying a home or an investment property to rent or flip and turn around. That's an investment type. Cryptocurrencies, Bitcoin, those kind of things is a type of investment. Those are crypto is highly volatile. I didn't put them on the main list because when you're talking about retirement plan, I'm not adverse to having crypto in financial retirement plans, but a small percentage, and really only after you have the rest of the plan covered and you have your basis covered, then you can dabble in crypto a little bit. There's still a lot of uncertainty there, and it's still very, very volatile, right? But some things are more for beginners. Other of these things we talked about are not. They're more higher end, but always get educated on it and or work with a financial advisor that can help you out with that. The clients I work with, we sit down and we figure out what their risk tolerances are, what their goals are, and it's personalized for each person, right? Not everybody's different. It's not a one size fits all, but there are core principles to adhere to. All right, so I want to go through a couple of things real quick. And again, this guide will be put out there. There's different investment strategies. So when I talk about putting together a financial plan, we got to figure out what is the strategies, right? What are we going to do and how are we going to attack this? So there's passive and active strategies. Passive is a little less managed, meaning you're going to get into indexes where I mentioned earlier, like there's an S&P index, there's a large cap index, a lot of different indexes. So you just put your money in this index and you just let it do its thing. Whereas active means you're actively managing the portfolio a little bit more. You're in and out of stocks, you're in and out of ETFs or different investment vehicles, and you're actively managing and getting in and out of things at the appropriate times based on what's going on. There's growth investing, which means simply that you're trying to grow their portfolio, but you're investing in growth type companies, growth type stocks, growth type of vehicles, because you can classify stocks that way as well. Growth stocks versus, for instance, dividend stocks. We see that on another section here, dividend growth, where you can invest in companies that pay out regular dividends, and usually look for ones that are strong companies that have a history of increasing their dividends. That kind of ties in. So you got dividend growth investing over there to the side, and in the middle you have income investing. Dividends definitely count for that, or count in that category. So there's a little dotted line there. And what it means by income investing is you have your money working for you, whether you're getting interest out from different vehicles, could even be rent from investment properties, or dividends coming out of stocks that you buy. Lower risk, lower flow, but that's income. Now, a lot of times with your financial plan into retirement, you may be a little more riskier as we're building your portfolio up. And then when you get closer to retirement, then into retirement, we're going to shift into less risky and may get a little more into investment, income investing versus growth investing at that stage. Value investing, you probably heard, Warren Buffett does a lot of this. It looks at the value of the company, the value of the stock, and the ratios. Is that company a good buy at that time based on the stock price, based on a lot of other factors like PE ratios and those kind of things? And is it a good value to buy at this time? He's also very sound about strong foundations in the company as far as target markets, their products, their leadership, their core. Indexing, talked about earlier already, that is buying ETFs or mutual funds that pretty much auto diversify for you, so you don't have to think about it. You just buy an index fund that automatically invests in all these different stocks and companies for you, but you can choose what segment to get into. The contrarian investing, kind of far off to the right there, it's actually investing against the market, right? Which which way it's going. So you're talking about shorting, talking about options, futures, those kind of things. You really got to do a lot of deep analysis, know what you're doing there, but it is one type of strategy that's out there. So we got to figure out what's best for you, and it may be a combination of things, and definitely a shift later on as you get further along in your journey toward retirement or in retirement. So also factors to include when you're considering investments: complexity. How complex is it? We talked about some simple things. There's investment types, and there's some more complex things. If you don't know about it, don't dabble in it. What the cost of it is there fees associated with it? Is there commissions? What's the cost to get in? What are the requirements? And the pure cost of the investment itself. What's the risk level? You got to know your risk level. Are you willing to take on a risk? And can you ride it out? One of the biggest reasons people hire financial advisors to ride out that wave. You have that emotional wave, and when it's your money, it's very easy to do a knee-jerk reaction, which is the worst thing to do. Whereas a third party can kind of take that emotion out of it. But you got to know your risk level. Are you conservative? Are you aggressive? Are you in the middle? I know I personally do risk assessments with people to kind of see where they sit. So we want to make you comfortable inside your risk tolerance, but at the same time, you got to choose the right risk level and the right investment vehicle based on where you're at in your financial plan, right? And what you're trying to cover. Big factor there. And then of course, what your goals are. You got to know what your goals are. That all factors into what we're going to invest into. All right, and then a little bit breakdown a little bit for investment type by risk. I'm not going to go through all these. This is going to be in the document, but you can kind of see low, medium, high. I talked about crypto and being a high risk, and down at the bottom there you see CDs, low risk. So you can take a look at that. It just kind of pyramids out what the different risk levels are and the different investment types. Kind of handy to have. And then further breaking that down, there are different types of investment risk. These are just a couple. There's a lot more than this. Purchasing risk, the risk of the loss in the value of cash due to inflation, or inflation risk, right? Your money doesn't go as far, right? So if inflation is going up at a high clip and you're invested just in CDs, those CDs are not going to outpace inflation. So your purchasing power inflation risk is huge. You're actually losing money because you're not covering inflation. Reinvestment risk, the risk that the interest income and principal repayments will have to be reinvested at lower rates in a declining rate environment. So when you're reinvesting those funds, you got to have a plan. Is the interest rates going down? Are they going up? Are they stagnant? This kind of comes in more into play when you're talking about CDs and fixed investment vehicles that have fixed guaranteed rates. You got to be cognizant of that. Interest rate risk, the reduction of value of a security, especially bonds, resulting from a rise in interest rates. If you buy a bond at a certain price and at a certain rate, and the interest rate is changing, and right now we got rates going up from the Fed. You get to understand the bond market. You really have to understand the correlation to interest rates and what the Fed is doing, because that has either a positive or a negative effect on bonds. So interest rate risk, you got to understand that to really get in to the appropriate bonds. Political risk, when the country's going through turmoil, or another country, not just here in the U.S. or abroad, the political demographics of what's going on, the political temperature, and then also you just hear flat out news of things that's going on that will affect stock prices and affect those companies. You got to kind of be cognizant of that, and that's very hard to predict. I mean, you've probably seen the stock market go wild based off a certain piece of news. It is very volatile in that way, but there are some indicators, and definitely there's political and I would call it news risk, about what's going on that can affect your investment that you don't really have a lot of control over. Exchange rates, this is really when you're getting into, we didn't talk really a lot about it, but I listed on their swaps. This is exchange rate risk, which is basically the exchange rates of money, right? If you're dealing in international investments, the value of the dollar compared to the value of a yen or whatever may affect your investments, right? And affect the value there. One thing that I talked a lot about earlier in an earlier session was sequence of returns risk. Well, that's not necessarily a type of investment risk. It's a portfolio planning risk. We're going to talk a lot more about sequence of returns risk when we get a little bit deeper into the retirement planning sectors of this group, which we're going to get into really quick. The sequence of returns risk is huge for a portfolio that's managing your portfolio so you don't take a hit within a few years of retirement or the first couple of years into retirement. And I'll show you some examples of what that looks like, of how sequence returns can be huge risk for your portfolio. All right, so that's it for tonight. If you have any questions, shoot me a DM. Just put a comment out there. If you guys, you can go out there and look at the guides. If you go back and want to watch through some replays and you're not finding them as easy on the group, I'm going to put my YouTube channel up. They're all posted out there on the YouTube channel, as well as some other. I put a bunch of shorts out there, real quick hit videos, and in the future I'm going to be putting some other content videos out there as well. But all these group videos are out there. And the other thing is, if you want to, I'll put this in the comment section as well. If you want to schedule a time to talk, if you have questions about what we've gone over, or if you just want to talk about any of those, that's my calendar link. I'm going to put it in the comment section afterwards as well. So feel free to schedule a time to go over things. Let me look real quick to make sure, see if there's any comments. If you have any, you can drop them in the comment section here. I'll be hanging around for a minute. I'll monitor it afterwards as well. I can answer your questions there. Or like I said, just hit me up in Facebook Messenger. So that's it for investment risks, and types. And hope you got something out of this and learned a little bit. We're going to take this information and what we've talked about tonight and apply it to how that goes into your portfolio, how it goes into your plan. So in the coming weeks and next week and for a few after, we're going to talk about some of those different aspects of your retirement plan, some of those different aspects of what makes up your financial portfolio. In that first session about retirement that said, are you ready? And we went through the different pyramids, the different buckets, all these different things that you got to think about in retirement. We're going to start taking those in chunks and digesting them a little bit. So guys, I appreciate you joining. I look forward to next week. Let me know if you have any questions, and I hope you all have a great rest of the week and weekend. Take care, guys.